Hello and welcome to your Monday Futures Market Outlook for July 12, 2010. This is Patrick Ceresna. For those of you that have not had an opportunity to try out eminisource.com, 30-day complimentary memberships are available, no credit card required. As always, we start off with a weekly chart of the S&P 500 going back 3 decades, and when we plot an 80-week moving average on there, does a very good job to depict the bull and bear market cycles the market has gone through. Just many months ago, we actually crossed bullishly above that 80-week moving average, asking the question as to whether we are beginning a new multi-year bull market. There are 2 possible scenarios that we continue to favor here. The first scenario is one that the market just continues to consolidate into the summer, finding an important low somewhere between the 950 to 1,000 level on the S&P, and subsequently spends the remainder of the year rallying higher. But at this point, we also cannot rule out the possibility that the entire rally that we've had off of the March 2009 low was nothing but simply a secondary retracement of a primary bear market. If this scenario starts to materialize, we would see market weakness breaking well below the 1,000 level on the S&P and start accelerating on the downside. Under those circumstances, there are much more bearish implications to that kind of an outcome. So we're at a critical level over the summer at these levels around this 1,000 area on the S&P, because if it holds, it could be where the next major rally begins, but also if it breaks down, it would solidify a new major down leg in the market. When we take a closer look at the S&P 500 using that E-mini futures contract, we see that the market at this juncture has broken that flag we've been discussing for over a month now, and subsequently headed lower down toward our 960 to 1,000 level target on the downside. Since then, we had a very robust counter rally that has worked its way all the way back up to this 1070 level. This 1070, 1080 level right in here is a very critical moment, because this is simply the retracement of an oversold market. If the market is going to roll over and continue the trend that's been in place, it's going to come off of this level back on the downside. In the same regards, if they really want to short squeeze the shorts and the bears out of the market, they would need to make a significant push above this 1080 level. If they do, then we could see a very robust squeezing higher up towards that 1120, 1140 zone on the upside. So we sort of have a line in the sand that probably the next 48 hours will resolve right off of this level right in here. If we do roll over and start to sell, especially breaking below the 1040 level, our targets again are down in the 960 to 1,000 level. We did have a basic test into that, a pre-market test went as low as the 1,003 level, but we think that that area can be solidly retested in a new wave of selling if it rolls off this level. To review our key points, our thesis since January 2008 has been that we're in a secular bear market, and we haven't changed that thesis simply because there's no technical evidence to do so. At this point, the only time we will consider changing that thesis is that if we see this summer sell-off that we've started off here, find some really good basing in that 950 to 1,000 level on the S&P, and if it holds into the summer and early fall, that could be a baseboard from which a new robust rally would begin, which we would then change our tone to a more bullish one. But in the same regards, if the market deteriorates into the summer, then we're going to maintain our thesis and see where and how low the market is destined to go. Last week we were talking about the fact that there was room for a short-term bounce higher, and we basically got that. But in the overall, we are in sell mode and heading to our lower downside targets. We haven't really changed our theme, but really at this 1070 to 1080 level is exactly where we're going to get resolution to whether or not to maintain that bearish theme in the bigger picture. Because if in that bigger regards, a break above that level would see a short squeeze on the upside that neutralizes all downside momentum. In the bigger picture, though, we continue to be skeptical about the sustainability of any rally into the summer, and it's important to stay conservative in your investment portfolio. Next here, I want to take a look at the NASDAQ 100 using the E-mini futures contracts. The scenario is the same. We had that flagging formation. Now we have a counter rally coming off of our downside targets up into the retracement zones. Again, if this 1810 to 1840 area rejects the NASDAQ and rolls it over, we still are looking for proper testing down into the 1600 to 1700 level on the downside. Next year, I want to take a look at the US dollar index futures contract, and essentially when we had that little consolidation at the end of June, working around that 85.50 to 86 area, once that level broke on the downside, we began the second leg of a zigzag formation. We still believe that this is just a retracement move lower and that the US dollar will head higher. It finished its move down to our downside measured move down into 83 to 50 to 84.50. So it's actually quite possible that we see the US dollar begin to rally off this level, and if we see a good solid push above 85.50, 86 on from where the overhead resistance is, that would confirm to us that that the dollar index may be beginning a new uptrend. But we first want to see follow through off of this level. Next here, I want to take a look at gold futures, and we more or less had a very significant technical breakdown the other week, but more or less have spent this past week just consolidating sideways. We still believe there's room for, at this stage, the gold to come down and test that 1170, 1180 area below, but there's also some moves that could even target 1150, even 1130 on the downside. Nonetheless, it's worth noting that in the past, every single gold sell-off that has sort of played out this pattern started to base and reverse off of in this time frame. So will be interesting to see whether there's still one more lower push in here. But if gold stays true to the trend that it's had in place up until now, then really there shouldn't be that much more downside beyond one or two thrusts and then a good basing, and then most likely gold will roll up from that level. So we have short-term concerns, but nonetheless still respect the big picture trend higher in gold. Next, I want to take a look at the mini crude oil contracts. So we were talking about that same flagging formation that we're seeing almost in the S&P, had a breakdown of crude and then subsequently a little retracement higher this week. We still continue to believe crude oil is bearishly positioned, especially if the US dollar does rally, then crude oil will roll over and sell. If it does, we'll be looking for testing not only at the previous lows into the 68.70 level, but some of the bigger picture measured moves over a month or more can span all the way down into the 60-66 area on the downside. But in order for that all to materialize, we need to see the dollar index start to rally and oil to roll off the 76 level right in here and start selling on the downside. So we'll be watching what plays out. Any break above that 78.80 level on the upside of crude oil will immediately neutralize any downside momentum, negate the flag, and create much more range-bound markets for crude oil. So it'll be really critical for the bears, if they want to see crude oil sell, to roll it down from this current level. Finally, I want to take a look at the 10-year Treasury notes, and everyone is commenting again that the yields on the Treasury notes are back above 3%, but from a technical perspective, there's certainly no positives here for a reversal in the bonds. There's at this juncture, we have this triangle formation that was sort of the midpoint, and subsequently at this point we're progressing higher in a very distinct uptrend. We had a push above this 122 to 122.5 area, but now are sort of flagging into there. If at any stage this little flag over the last week breaks again higher, we should complete those targets up to the 123.5 to as high as the 126 area on the upside. We don't see no reason to become bearish on the 10-year Treasury note yet. That was your Monday Futures Market Outlook. Thank you for joining me.